You've written down a dozen risk rules from a dozen trading videos, and at the click, you still freeze or move one. Every rule became one more place to override yourself. But I was sure the fix for me was more discipline. Then I lost 9 trades in a row and survived only because of how I managed each loss before I clicked. So I'll give you the 3 rules that I kept and the 1 move that makes them work so that the noise stops reaching you. 3 lines on a card set in order before every trade, and line 1 trips almost everyone. They set their risk as a percentage, and it sounds disciplined, but a percentage moves with your balance. So with every trade, you are deciding what you are willing to lose, and that is right when you are least objective. I ran the same 30 trades 2 ways. Once risking a percentage that floated, and once risking the same fixed dollar amount. Same trade setups, same 40% win rate, same 2-to-1 winners. The fixed dollar version came out slightly ahead, recovered faster, and I stopped flinching at each bet. So line 1, choose one fixed dollar amount that you are willing to lose, a flat figure that doesn't drift. Now your position size stops being a feeling and becomes division. That dollar risk divided by the distance to your stop loss gives the exact size every time. The percentage rule was one you reopened on every trade, and every rule you can reopen is a place you override yourself. That is the override surface. The cost of a rule is the number of moments it gives you to deviate, and a fixed dollar amount gives you none. And notice who wants you to trade bigger. Every channel has a reason to sell you one more rule, one more confirmation. Nobody builds an audience telling you to delete 17 because subtraction doesn't sell. A fixed number protects you before the trade, but the rule traders break the most is the one they move once the trade is live. Under pressure, you reach for the same one every time, and the free diagnostic quiz in the description below shows you which one of the 3 is yours. Check it out below and get your diagnosis. Line 2 is your stop loss, and its distance comes straight from how much the market itself has been moving. Paul Tudor Jones built his name on one habit. He knew where he was getting out before he ever got in. An actual price, the level would prove the trade wrong. The moment it hit, he was gone. No negotiation, no giving it one more trading candle. The traders around him kept sliding their stops, because in the moment, a losing trade always feels like it's about to turn back. His edge was refusing to have that conversation with himself at all. He set the line while he was calm and let the calm version win. So line 2, take the recent daily range, how far the market has been trading lately, place your stop loss as a fraction of that beyond the structure. The level price would have to break to prove you wrong, beyond the noise, and never just a flat round number, because normal market fluctuations should never reach it. Then the part that matters more, you don't move it. Not to break even, not wider, not an inch. I don't touch a stop loss once it's set, because the version of me that placed it could see the whole picture, and the version watching it sweat only sees the potential loss. Moving it feels like control, but it's the most expensive override there is, because it turns a planned survivable loss into proof that you can't follow your own plan. So size is locked and the stop loss is locked. The last line is the one fear attacks the most because it's one that pays you. Line 3 is your take profit, set at twice what you are risking before you ever click. Twice because of what it does to the maths. A famous Stanford experiment explains the hard part, and likely better than any trading book. Researchers sat children in front of one marshmallow and offered a deal. Wait 15 minutes without eating it and you get 2. The ones who held out did not white knuckle it. They turned around, covered their eyes, and pushed the plate away. They got the temptation out of sight instead of fighting it. Everyone remembers that as a willpower test. It was really a hiding test. With the marshmallow gone from view, waiting got easy. Your locked take profit does the same job. It waits for the 2 while you go and look away. So line 3, the moment your stop distance is set, your take profit price rests at twice that distance, placed as an order in advance. Here is why twice. Set the reward at double the risk. And the maths only needs you to be right 4 times out of 10. 6 losses out of 10 and you are still standing. The structure does that on its own. It says nothing about what your account will do. But it's why a run of losses cannot bury you, as long as the target was fixed before you got in. Move it the second a trade scares you and you never had a target. You just had a hope with a number taped to it. Now, walk it once. You'll risk $50. Your stop loss sits at a fraction beyond the structure, 20 points out. So 50 divided by 20 sets your size. Your take profit rests at $100, twice the risk, and placed before you click. That's the whole card. 3 lines set in that order before the click and touched by nothing after. And the reason it beats a binder of 20 rules is simple. You just deleted every place you used to override yourself. The card runs the same on any trade. What it can't tell you is whether the trade was worth taking. And a flawless routine on a bad trade setup is just a slower loss. So watch this video next, where I break down the filter that I use to throw out most trade setups before the card comes out. See you in that video.